Hello, good afternoon, everybody. It's IBM TV Modern Investing with Sasha, and I would like to introduce my guests. It's Peter Bennett, who is our regular. He's an independent investor, and he is a great contributor to our program. And also would like to introduce Roderick Mann. Hello, Roderick. How are you? Great to have you on the show. And I would like to just make one remark. I'm suffering. I hope you don't, but I am suffering with the deterioration of the quality of my portfolio because as dividend stocks are doing better and better, but their yield is getting lower and lower. You know this type of problem. So overall, then you have lower yield, but your risks are probably even greater than ever because I can see there is a tug of war because from all indications, the stimulus package and everything else, the money is pouring out and there is no other place for them to go as a stock market. So it should go. I wouldn't be surprised if in a scenario like that, stock market like Dow Jones would go higher 500 points every day. Because if money is pouring in and it's not going out, so the Dow must go higher and higher every day. Well, it's not really happening though, because you can see Dow is struggling right now. And we don't know which way. I'm watching also Russell 2000. I'm watching a couple of other indicators. I think there is a tug of war between people who think likewise myself, that money should go into the market, therefore the market has to go higher. On the other hand, I think people are getting worried that with US dollars going lower, so there will be incentives for interest rates to someday go somewhat higher. And as soon as that day will arrive, nobody knows what's going to happen with our portfolios. It can go down big time. Like a couple of days ago, remember I was talking about Russian index, RTC. It's a great thing to invest, and it could go to very quickly to much higher levels, except one thing. If US will have, let's see, correction, even 10%, RTC will go down 75% in an hour and a half. And that's what we don't want to see happen to our portfolios. So we have to really mitigate this quite complex situation. And I would like to ask you, Peter, how you what is the right way to mitigate? And one more remark before I forgot is that as US dollar is going lower, supposedly, for example, assets like Bitcoin, so it went go much lower last week, but even today it's 1% lower from yesterday. So how is that possible? That US dollar is going lower and Bitcoin at the same time going lower? How does it work, Peter? What's in your opinion
Well,
the logic?
a few points. One, I would rephrase. I mean, I'm having the same struggles, but it's not that our portfolios are deteriorating because the values are going up. It's just that it's harder and harder to buy new things.
Is this right?
Yeah, exactly. Because I mean, but it's a real struggle for yield, first of all, and it's a struggle for everything. I've never spent so much time looking, but I'm still finding things, and I have a few on this program to throw out there, but it's less and less because as values go up, obviously the future's more discounted. And I think I've been saying all year, really, I mean, it's a struggle for the market now because, first of all, because it's gone up so much, but second of all, there's a fear of interest rates going higher. although the 10-year went down to 1.5 recently, where it had hit 1.7. But it's very hard to know the future because on one side, everybody is saying, oh, there's going to be more future inflation. There's a lot of commodities inflation right now. Energy prices have been going up and a lot of raw material prices. You hear that all over the news shows. Companies are trying to pass on these increases. P&G just raised their rates. They said, because of the commodity costs, a lot of companies are doing that. But so you have a real struggle. But the real question to me is the long run. And this is why I still like dividend stocks, because I have thought that rates would go up this year and then the stock market would struggle. But I think in the long run, rates are probably going to zero in the United States, like they are in most countries, because of the huge debt. And when the debt, especially the unfunded debt, I've talked about this before, but basically every country in the world has promised free healthcare for these aging populations. It's not just the U.S., but the U.S. alone has promised more in unfunded liabilities than all the stocks, bonds, and privately held real estate combined. This is off the books. They haven't funded it, and they're not even admitting they owe it. So they're saying that the debt in the United States is 27 trillion, but it could be 200 trillion, 150 trillion, maybe 250 trillion. My only hope there, by the way, is that healthcare costs will come down a bit, and maybe that will help a bit. Maybe cures and robotics and things like that. But and it's not just the United States, so I don't want to say, oh, get out of the dollar, because all the other countries are offering free healthcare already, and they haven't funded the fact that their populations are aging. China has a hugely aging population, but all the countries, India, they all have, I've looked around the world. So if you look at it down the road and say, wait a minute, getting 2% on a 1.5% on a 10-year may be fabulous in 10 years, because you may only be able to get zero on your rates or very low rates. And I'm about 80% that that's going to happen. Nobody can say for sure. There could be massive inflation too, but all this money printing is going to cause something, probably. So if it is low interest rates, which will be the goal of all the governments to keep, because they don't want to pay interest on all this money that they're going to have to produce anyway, then maybe the market will keep climbing higher, and rates will just in the next year or two, start declining as they have. I'll make this last point for now, is for 40 years they've been going down almost steadily like a straight line. They went down a little extra during COVID. But once they returned back to that straight line, if you projected 8 more years out, and I have the chart, you say, okay, well, we've been heading for zero for 40 years, where we went a little lower during COVID, but now it'll bounce up a bit. Everybody will get scared of inflation, but then it'll probably continue on that 40-year track.
Okay, I'd like to introduce our another guest. It's Shaquille Latimer. Hello. Hello, Shaquille. Welcome. Sorry, there is a noise from somewhere coming on. Okay, Shaquille, how are you today? Welcome to the show.
Well, thank you.
Okay, I would like to ask Roderick, please, how you mitigate these problems with stock market. It's almost like internal fight between forces that dictate it should go somewhat higher, and at the same time, it could, in my opinion, have correction 10% at any day. I'm thinking, or even the next half an hour. I really don't know what to do about it.
I think as long as we continue to get waves of trillions in liquidity, the money has to find asset homes, and I think what we're seeing is they're all over the map, and a lot of that digital images and things like that. So I think there's a lot of confusion right now, and whenever something bad happens, we do get a little bit of a correction. That's been the case the last year or so. Bad news about the pandemic, or the interest rates go up, or Biden is going to tax capital gains. It's a little bit of a shock, comes down a bit, and then they buy it right back. So I do sense that in the month of May, we're probably going to get some kind of correction, but I also believe that'll be bought right back. I think as long as this money just keeps coming, it's going to go right back. But I also think there's some confusion, and so what's happening is the market is becoming bifurcated. I think on the one hand, you have some people who would subscribe to what Peter just said. And that was actually my opinion for a long time, and now I'm not so sure. But it's also Lacey Hunt and Ray Dalio and people like that, that there's way too much debt. And that debt has the effect of suppressing GDP growth and taking interest rates way down. And that's been true historically. And we can look at empires like the Dutch and the British and see, what that did to them and their overreach did to them. So, but what's happening is a little bit different. Is the evidence for the inflation appears to be growing more and more, and price increases. It's it was lumber, it was copper, it was a handful of commodities. Now it's kind of getting all the way through the system, and a lot of it points to the fact that we're capacity constrained. So we're having to bootstrap new capacity, which is expensive, and we've got these supply chain disruptions, and they're serious. The microchip and some of these other things, they can't just turn on a dime. It takes months for them to get that back to where it needs to be. So I do think we'll see inflation. I think we'll see a pretty good uptick in the CPI in the May numbers, which will be reported in June. And here is where I think the jury's out and why it's bifurcated. I think a lot of people historically believe that once inflation kind of takes hold, it psychologically wants to grab a hold of that and continue to go because people buy more, they buy more often, they buy faster. And so the psychological impact, not just the velocity in the high M2 money supply, the psychological impact starts to take over and it feeds on itself. And so this idea of temporary inflation or transient inflation, that's kind of disputable because the Fed is trapped. They cannot raise interest rates. And historically, only increasing interest rates will nip inflation in the bud after you've got that psychological impact. So, what's happening is I had a pretty fair amount of money in TLT. Those are long-term treasury bonds. And I got out of that a couple of months ago and I got into TIPS. Well, the TLT is down 13% year to date. And the TIPS I bought a couple of months ago are up slightly. So I think there's the anticipation of inflation. I think there's the psychological and historical argument that once you get it, it's really hard to control. And I also think that Jay Powell is trapped. He keeps saying 2023, ZIRP until 2023. But I think he's saying that because he knows he would crater asset values and send interest costs through the roof for every full point of interest that comes up. So he doesn't have the tools. He never describes those tools that he talks about for fighting inflation. He says we got tools. He never says what they are.
Shaquille, what do you think?
Sorry, I actually missed the question because I wasn't here.
Oh, okay, no problem. Well, we're talking about long-term, short-term and long-term inflation and how it's holding the market back. In other words, everybody seems to think inflation is a fear right now. Roderick had thought that in the long run, he agreed that probably we're going toward very low interest rates, which is what I think it's like 80%. But Roderick recently has thought maybe inflation will kick in, which is always a possibility in my mind too, which is why, by the way, I hold 3% gold just as a hedge. But what do you think in the long run the prospects are? Inflation or deflation, or neither?
I'm not a Canadian, I'm a Keynesian, but what they say, the long run, everyone's dead.
That's true.
I do think, to be perfectly honest, I actually think the interest rates will head up. I think they'll head up sooner than what people think. A lot of the fear, and I harbour this fear as well, is if interest rates move up, what effect does that have on the US government's ability to pay its debts? Or I should phrase that, what percentage of US government income is going to be used just to make interest payments?
So are you talking about the long run? I just want to clarify, Shaquille, are you saying that you think they're going to, because a lot of us agree it's going to probably go up in the next 6 months here, but are you talking about over the next years, like the next 5, 10 years and more?
Yeah, I'm trying to look forward to the next decade, over the next decade.
So you think they'll lose control of the interest rates?
Well, I think that the international arena will have more of an effect than what the Fed will have in trying to artificially keep interest rates low. And I think that the concern about what percentage of the government income is going to be used to make interest payments just isn't going to factor into that as a concern. In relation to inflation, look, I do think that you're going to see inflation. The big question is whether or not there is going to be enough uptick in the economy in general, whether there's going to be a much bigger labour force participation, that sort of stuff, in order to absorb that inflation. But the thing is that if there's not, you end up with some other issues. So some of the issues is that inflation, lots of people think inflation is really bad and terrible and that sort of stuff, and it can be, but some people benefit from it quite a lot, and tends to be existing asset holders. They tend to benefit from it. The problem ends up being that you don't have any new buyers because they can't afford to buy in. And so they can't afford to buy real estate. They can't afford to, buy shares and things like that. And then you start to see some problems. I think we'd really hate to see what we saw in the last century, which was stagflation. And that, I think, would be a real risk for the United States. But the US is still currently the world's reserve currency. Let's go down a doomsday scenario and say that they lose world reserve currency status. Let's just say that happens. The US is still a significant economy within the world. And I think that when you look at inflation, you have to look at inflation relative to other economies. Right. So inflation really, it doesn't just happen in and of itself. It is, how much can I buy with my dollars today versus how much will I be able to buy tomorrow? A lot of goods, especially in the United States, which is importing so much stuff, a lot of goods are bought from overseas. So therefore, if those other economies have also had similar or worse levels of inflation, relatively speaking, the US will survive that, fairly unscathed. The other thing that's worth noting is the dollar index. At the moment, it's trading around 90. Which is, fairly low for its historical average, especially over the last 5 years. That's a fairly low price. You'd be expecting it to be sitting somewhere around 100 can be a bit high as well, but you'd be expecting it to be somewhere in the middle of that range. So it's towards the lower end of that range. So you'd expect the US dollar to perhaps outperform some of those other currencies that are in the basket if the US economy is right. Now, I won't get into the politics of the United States right now,
sure,
except to say that whatever political decisions are made in relation to how best to manage the economy and how best to bounce back from this COVID situation, the COVID pandemic, those decisions, I think, are going to have a much more pronounced impact than just inflation generally. I think that will affect the value of the US dollar and its attractiveness as a currency. Whether those decisions are good or bad, I'm not going to comment on that. I think we know what my feelings are, but I won't comment on that. But that's the thing to watch. And I don't think that you're necessarily going to see like an instant result that the current administration does something and then tomorrow there's a huge reaction. What they do today is probably going to be seen in 5 or 10 years' time. And we saw this in the Great Recession, the Great Depression. We saw that certain things that were done in the early 20s had effects 10 years later, and certainly in the aftermath of the Great Depression in 1933 and 1934, where they started to really start doing some more significant interventions, you did start to see, the effects of that later in the 30s, early in the 40s.
Right. You just brought up several good points. One is that's true. If the whole world, but I want to throw this out too, but if the whole world has the same similar issue because they have to print a lot of money, then it's all relative, which was an excellent point. But here's my thinking of why it's probably going to be low interest rates. But one, that's going to be the goal of the U.S. and the world. But all these countries are printing it. But the first is the term yield curve control. Now, what that means is the government basically comes in and buys assets and to control the interest rates. And it was done during World War II for about 11 years. The United States actually did yield control. And in 2016, Japan did it. They attacked the 10-year by buying all the assets, and they basically announced to the world, okay, if the rates, I'm just going to pick a number. Let's say they just say, if 10-year goes over 1.5%, we're going to buy everything. And then the whole mentality of the market shifts during yield curve control. And so when it happened in 2016, the Japanese market, they didn't have to do anything anymore because the market got used to it. And now they're stuck with low interest rates. And then you look at the Fed now. They already own 1/3 of all the mortgages in the U.S. They've been buying tons of bonds and other assets. They're starting to get into buying other types of assets, even maybe, I believe, high yield. So theoretically, they're the buyer of themselves in this, situation.
They're still dealing, of course. I mean, I'm not the biggest fan of the Fed as an institution. No criticism of how they operate, but I don't really see the purpose of it. And the idea of creating the debt, creating the money, buying the debt off yourself, or buying the debt off Treasury. Yeah, look, I can understand that
they're doing it now.
And I understand that the idea is to try to mitigate some of the effect that would have on the money supply more generally. But I personally would posit the view that the free market would be a better arbiter of that. But just leaving that aside, look, the Japan, for example, yes, they've got very low interest rates, but that's made up for the fact that they have deflation and have had since the 70s deflation, so they're okay. They're actually in a quite a good position because up until fairly recently, they were the lowest yielding. They were at 10 basis points. And so that was used as the funding currency for a lot of carry trades. And the British pound used to be the big anchor of that. 10 or 15 years ago, everyone was talking about the carry trade between Japanese yen and a British pound. A smaller one was, of course, with the Australian dollar and the New Zealand dollar. But we're not talking about that anymore because everybody's at record lows.
Right, everybody's at record lows.
But what that does also gives a disincentive for international money to flow into a country. So if you have a look at Japan, interest rates were very low. Absolutely. Money was coming out of Japan and going to higher yielding economies. So that's not going to be sustainable forever for the United States, in my opinion. I think that they're going to have to do something about that. And it is
what would they do? Shaquille, what would they do?
Well, just one second. It is a balance between inflation and the current and interest rates. However, I would also just point out that some of the things that you've mentioned before, such as the aging population and all those types of things, they are very valid points. But the United States has a very unbalanced system. The taxation system, for example, is extremely progressive, and it's not particularly broad, just at a federal level. It's not particularly broad. So if you compare it to another country like Sweden, for example, that has also got an aging population at the moment, which I really wish it didn't, but it has a little bit, not quite as pronounced as it is in the US, but it has an aging population as well. You see there that they've only got 2 or 3 rates of tax, and 1.5 times the average wage are at the top rate. So their tax base is quite broad. If you have a look at Australia, we've now changed. We only have 3 rates, 0, 30%, and the top rate. Again, we've got a fairly broad, and we've got a national sales tax. So we've got a fairly broad taxation system. Those are going to help our countries mitigate this. With the United States, it's not so much I'm going to make a suggestion about what they should do, because I'm not sure there'd be the political wherewithal to do it. I think what's going to force the issue is just the plain economics of it, which is that what does the US do when other countries that have got similar demographics, like Australia has an aging population in very much the same way as America does. We have the same levels of obesity, heart attack, cancer, all that sort of stuff. They're all fairly similar. So when other economies start to outperform the US, it then just becomes an economic decision. And I think that the Fed will start to make decisions based on that instead of relying on government policy, and that will really force a change. The big thing
I don't understand. I mean, it's quite possible, but what do you mean those decisions? Are you saying they'll let rates go higher, or they'll be forced to have higher rates where massive inflation could kick in?
I think that they'll be forced to bring rates higher, and I don't think they'll be forced to I mean, normally you bring rates high. It doesn't necessarily cause heaps of inflation. Expanding the money supply is going to cause heaps of inflation. But what I would suggest is if you start to see rates go up, you also have to have a look at what's on the balance sheet of the Fed. So they need to start buying back or sorry, rephrase that. They need to start offloading a lot of what's on their balance sheet. The other thing that's important to note, well, they started doing that under Trump. But the other thing, pre-COVID, they started doing that a little bit more aggressively than I'd have liked to see, but they were doing that. The other thing that's really important to note, I know that Roderick talked about the M2 and M3 money supply. The other thing that I think is just really important on that note is most people think that the Fed or the central bank of any country is the one that creates money and destroys money. Yes, they do, but not to the same degree that the commercial banks do. And so
let me throw something out.
Hang on, they can influence that, and if they influence that and they can decrease the amount of money that's out there, that can help to counterbalance the inflationary pressures.
Let me throw this out then to the panel even, but here's my theory of that. It's almost like a one-way ratchet down. It's not a total one-way ratchet down where it's hard to increase rates, but let's say you have, I'm going to give an example, and let's say you have 10% mortgage rates and you drop it to 5%, then housing prices adjust based on that. And everybody's got mortgages based on that, and the whole economy based on that. In other words, housing prices go up because mortgage rates went in half to 5%. Wait, let me finish, because you don't know where I'm going yet. So basically, now it puts workers to work building houses. The whole economy is booming. Realtors are selling houses. Now that's from 10 to 5. Now let's say you go from 2 to 1. This is my theory that all rates are relative. So that's the same basic change in terms of you've cut the rate in half. So that would have the same stimulative effect. So going down from 2 to 1, you're going to get a big effect. But now if you want to raise rates, wait a minute, it's the same as going from 10 to 20 or 1 to 2 or 2 to 5. You're going to crush housing, building housing, workers, the affordability of housing. There might be a mortgage crisis. It's hard to raise rates when the whole economy is a service economy and a consumption economy, isn't it? Or not?
Well, but you play those into what's happening in the economy. So of course, if you were to tomorrow just raise rates from 0 to 10%, of course that would have a terrible effect. But you raise them slightly based on economic activity at the time. And as I said before, what becomes important is, in my view, is it's not just the headline rates, but it's also the amount of money that's actually circulating. And so if you can pull some of that money out of the system, then that becomes an important way to balance inflationary pressures as well as interest rate pressures. But you couldn't have I think it would be unhealthy if you saw a situation where interest rates in the United States stayed really low, while other countries started to see an uptick. And the big ones that you have to watch out for, of course, are commodity countries like Australia, but also commodity countries like Canada, especially Canada, because they're so close to you. And that's going to have an effect, because then you see that the effect in Canadian trade and all that type of stuff. So I don't see them being able.
That's a good point. You just let me say then what you're saying is, just to clarify, you're saying basically you believe that rates in other countries like Australia or Canada might go up, and that will create outflows from the United States because rates will be higher there as their economies do better relative to the United States. I think you're saying that. So that could put a lot of pressure on the Fed and interest rates in the United States.
Hello, Joe. Thank you for joining us. Actually, I would like to mention something about what is getting somewhat scary exactly in Canada, and I want to tell you what I see here on an everyday basis. The food prices are going through the roof because all transportation is way much more expensive, and Canada exports a lot of food from US, from Latin America, from Europe, elsewhere. So the food prices are going through the roof. Now the gasoline prices lately also going through the roof, like everywhere, okay, because the oil is getting through the roof. And because of that, Canadian dollar went in a few months from 72, 73 cents. It's now about 80 cents for US dollar. So Canadian dollars gain. So all that is making Canadian economy much less competitive, number one. Number two, the real estate prices, at least here in Toronto area and in Ontario, they're going through the roof. Now, people who are starting out, they can't even think about buying anything, no apartment, no house. Absolutely, it's just impossible, simply because you still need at least 5% down payment. And with the prices like this, the average house cost probably $1.5 million. I mean, there's nothing. It's the same house would cost $400,000 just 7, 8 years ago. Today it's $1.5 million. How can you come up with the payment of 5%? It's next to impossible. People are trying to rent. Now the rent is becoming much more affordable because a lot of people are moving out of the Toronto area to country area because of this coronavirus thing and so on. So at least rent is more affordable. That's a good thing. How long it's going to go like this? Nobody knows. So what then forces are driving the interest rates staying as low as they are, at least here in Canada, with the Canadian dollar is much higher than it was, the real estate going through the roof, the food prices, gasoline prices, almost anything going through the roof. How sustainable is this scenario? Joe, do you have any idea?
Yeah, let me just say that I'm outside right now, so if you hear some sort of windy stuff, it's the wind. It's not me breathing. So sorry. It's like 80 degrees here in New York, so I thought I'd get some more fresh air. But yeah, I think it's just Federal Reserves, particularly starting with the U.S., keeping rates artificially low, and they're exporting these rates overseas. Because if the U.S. is keeping the yield curve right now, it's not a true market. We have no idea what the 10-year Treasury would price at if the Fed weren't in there practicing yield curve control, as Peters talks about. I have no idea. I mean, I guess there must be ways to approach it. I just haven't bothered to get into them because it's not going to happen. The rate is whatever the Federal Reserve wants it to be right now. And then in the global economics, macroeconomics, so then when the Federal Reserve keeps these rates low, then Canada has to keep them low as well, because if they let them get too high, the Canadian dollar gets too high, and then it's basically an austerity program.
It's already too high. So if you make interest rates higher, Canadian dollar will go to 95 cents or maybe over $1.
That's
so
a great point, Joe.
You have like an austerity program in Canada is what would happen if the Canadian central bank didn't act in accord with the U.S. central bank. So nobody wants that right now. So that's this notion of exporting your inflation.
That's a great point, Joe. That's like you're basically saying it's like a race to the bottom.
Yeah, right. Pretty much. I guess, but some things are during this.
Yeah, because no country wants to raise their rates because then, although that would make their dollars stronger, their currency strong, and then their exports would be hurt. So it's like, how low can we make it? Negative, which is a lot of countries have negative rates already.
Also, I'm telling you, I'm a little bit getting now scared about all these experiments with this all continuous stimulus packages and infrastructure, new money being printed like trillions of dollars here and there. I'm just curious, with all the new money coming in, how physically you can still keep the interest rates so low. I understand that you must keep them low just where they are, but where is the limit? Let's see. So Biden can print every half an hour trillions of dollars, and interest rates will still be so low. How does it work? I don't understand that.
Well, you know what? And the other thing is, and this is what I struggle with, what do you do about this situation? I mean, if you think interest rates are going to zero, then stocks are a great place to be, and that's where I think probably they are for the next 10 years and longer, especially dividend paying stocks like we discussed. And I've got a few of those for this program I'll throw in, but, or maybe you go with gold because, and a lot of people think I only have 3% in gold, but I definitely want some gold because one thing, if things get out of control, like Shaquille is saying, where rates just start going up, then gold may be the place to be as a non-correlated asset. But, what do you actually do about this if you're an investor? I
don't understand, Joe. Maybe you can address that because we discussed the dollar index went lower, for example, today, but so Bitcoin also went lower today, about 1%. How is it possible the dollar index going lower and the Bitcoin going lower? Shouldn't be that the opposite direction, or
I
it
know.
doesn't
I mean, I
matter?
wouldn't put much stock in one day's correlation. I wouldn't put any
Mhm.
stock in it, to be honest. So it's just kind of noise until you look at it over longer periods. But I mean, I would say that just to your broader point is just 2020 changed everything for me. Like I wasn't as big an inflation person as I am now. I mean, I was looking for companies and networks that would inflate from a traction perspective, but I wasn't thinking so much about dollars inflating this much. I mean, I knew it was out there, but 2020 just changed everything. When you have the Federal Reserve, I've heard figures anywhere from 30 to 40% more money now in the economy as measured by M2 than there was a year ago. You got to do something, and it's not something you can ignore. And obviously, it's a big threat to one's assets and wealth if you're not in the right place, right?
Yeah.
Like, and so I've turned into sort of a like an inflation maniac, or I don't know how to even say it.
Really?
Yeah, it's like I have to own stuff that's going to be sensitive to this, and it started a little over a year ago.
I think it's interesting to look at it from an
Yeah,
international perspective as well, and currency
right.
flows, because things do generally go in cycles, especially in more established economies. And just to slightly change the subject, but it is related to this, the Australian dollar just after September 11 fell to just below 40 cents US, which was, in my opinion, a ridiculous rate. Of course, it made a lot of sense at that time to load up on Australian dollars and to short sell the US dollar, because the US dollar bought you, $2.50 Australian, which was absurd. Now, of course, what ends up happening over time is the Australian dollar hit another extremely high rate. It actually went to $1.17 or thereabout. So, you do start to see those sorts of flows. And I would say that, with the United States, remember the US owes a lot of debt internationally. So, this can also be a way to counteract that inflationary stuff, is that if the US at a time now when the interest rates are really low is acquiring a lot of, and when I say the US, I mean American people as American companies are acquiring assets and cash in other currencies that they've essentially borrowed. When the US dollar becomes a much higher, much stronger dollar, they're able to pay down that debt and they're left with that difference. So there can be some long-term plays. Now, unlike China, the US and most other Western countries don't have particularly long-term plans. Politicians tend to, and government leaders tend to do things, per election cycle. But businesses don't. Businesses have a much longer horizon very often. Private people have a much longer time horizon, and you've also got to take into account the Middle East, because most Middle Eastern currencies are pegged to the US dollar. Oil is obviously priced in US dollars. You tend to see that when the US dollar goes down, there's a compensatory increase in the price of oil, and you see the opposite. Price of oil will come down as US dollar comes up, so that relatively speaking, they end up with about the same purchasing power relative to oil. I think you begin to see some of that happen with gold. Bitcoin and the other cryptos, I think, are a little bit too young yet to have found that level of stability. But these sorts of flows are all things that you'll see over time. So, to your point, Peter, and to Joe, I am concerned about inflation. I'm more so concerned about stagflation, but I think that there's going to be a lot more things that affect the markets than just headline rates and even just the amount of money that's actually circulating.
See,
May I ask you, Peter, may I ask you a question?
Very dominant.
Yeah. Go ahead, Sasha.
Quick question, Peter. Remember, in the last 2 or 3 programs, you were mentioning an effect of black swan
Yeah.
that could happen, which will derail or affect seriously the markets. Do you have any further thoughts on that relative to what we discussed?
I have a few thoughts. One, and that relates to the other thing. This is why I don't think we're going to have inflation. First of all, I've discussed a lot of times, I have a page of information just recently about companies that are offering their employees to work at home. And it's huge. It's like one company, 50,000, GM, 80,000, Microsoft, Salesforce. There's evidence everywhere. City came out with a report that said that they thought there would be a 30 to 40% reduction in rents in the next 3 to 4 years, and nobody out there is talking about this. I don't see it on the news shows, the business shows. It's like it's happening. It's almost like The Big Short book, because I feel like I'm seeing it. Maybe it won't happen, but if the rates go down that much, it's going to crush the economy in many ways, and also what stocks you want to be in. Because even the banks, I mean, they own a lot of what is going to happen when the bank is owed the money by the building that can't pay the mortgage anymore because the rates are down 30, 40%. People are moving out of cities and moving into their homes. And that's a huge change. Even infrastructure plays I'm concerned about, and there's so many other, because no more steel for buildings, maybe. So the whole market might collapse. The other thing, which I haven't mentioned much on this show, is technology tends to make things very efficient and, quote, vaporize things. There's a book called Vaporize. It's a fabulous book about how technology turns things from solids to liquids to gases. And it's like Blockbuster turned from Blockbuster to, online to streaming. And things just disappear. So, I mean, you look at just the EVs alone, driverless vehicles. 9% of the U.S. population makes their money driving EVs, and another 2% trucks. Now, if technology starts with driverless vehicles, which seem to be coming in the next 10 years, what are those 9% of people going to be doing? The same thing in restaurants. You have more and more restaurants where you can just go in and maybe robots are doing most of the job. And robots are great in a lot of ways, but that could be very deflationary in terms of replacing people with artificial intelligence, basically. So all these.
I'm not really as about that because of people said that about typesetting. When printing, no longer need to be done by typesetters.
It might not happen.
I forget the gentleman's name, but there was an old philosopher who bemoaned that when printing first came about, that the books weren't handwritten, and so people would be able to just publish any old thing, and it would sort of flood the minds of the young with stuff right. That wouldn't be worth printing before. Look, I think that we live in a dynamic society. I think humans are dynamic, and I think we'll just move on to other things. Yes, those people will be displaced, but as they age out as well, you'll start to see younger people going into. But you
will admit that technology tends to be deflationary, right? Because it creates efficiencies.
Exactly.
There's inefficiencies elsewhere. I mean, you look at accountants these days. Accountants don't do what they used to do. You don't have big rooms with hundreds or thousands of accountants doing the numbers. But you start to see people specialize in accounting, from tax accounting to management accounting, which is something that I was studying for a while through SEMA. So, you see people get into other things. I think that the job market will not be too badly displaced by automation.
You know what? I really don't know. I mean, the office market is coming before the job market, but you know what? My daughter's using TurboTax now, and she used to use an accountant. H&R Block is coming out with they've been coming out with really good software. And, there's a lot of other software out there, and more people might say, you know what? I don't need my accountant. Again, technology replacing jobs. Maybe.
Sure, but on the other hand, Peter,
let me, if you don't mind,
you're a small business, you all of a sudden have the ability to go into business for yourself without needing to have an accountant.
True.
That makes it easier for people to enter the market in the first place. So, Look, it's a double-edged sword, right?
Oh, I don't disagree. I do not disagree. You know what? It may be that many new jobs will be created. I just think that's another concern, and it tends to be deflationary. The office market may not collapse either, but it looks like it's more imminent to me. Joe, what were you going to say?
Yeah, please just give my view. So here's how my thinking is involved in this. So look, CPI isn't inflation. CPI is one measure of many measures. And Powell's already said, even if you see some uptick in CPI, I'm still not even going to react to it because I think it's transitory. Who's going to tell me I'm wrong? Right? So stop looking at CPI. It's a distraction. You have more money out there, it's going to go somewhere. And I've even stopped thinking about like velocity of money. Some people say, oh, well, you got to look at velocity too. I've dismissed that as even having an effect. Money will go where people with the money want it to go. Right?
And
so what's happening?
That?
Well, that's right. Well, that's the right question. So what's happened in the U.S.? I just wrote a list here while we're talking. What went up last year? Stocks went up. All right. So stocks are going up. They're getting record highs during depression era economy in a lot of people's mind, right?
Right.
Bitcoin
Yeah.
went up because people are looking for an inflation hedge. Junk bonds went up. Why did they go up? Because Powell wanted them to go up. He has more money than anybody. Again, we're in like the worst economy since the 1930s. Junk bonds should have gotten destroyed last year if you're a fundamental investor. If you're a distressed investor, you're saying, wow, this is my time to shine. I'm going to buy great companies for 30 cents on the dollar. Nope, think again. Junk bond spreads were at historical lows. So why? Because the guy with the most money, Paul, he said, I'm going to even buy junk bonds, right? You remember that. You guys have talked about that. I'm going to buy CLO tranches, which are basically, securitized junk bonds. And the other thing that gets back to my story is when I said I'm not a maniac, I'm a psycho thinking about inflation. It's really bugging me that I don't own more property, right, and luxury property in that. So I've been like working like crazy trying to get my hands on some. And what I see around the New York area, so like stuff in the Hamptons, for example, went up 30% in 2 months. That's hyperinflation. Why did it
Yeah.
go up that much? Because people with a lot of money and billionaires are buying it. So there's inflation all over the place. I say let's not delude ourselves. It's not here because it is, right? And
Oh
let's
yeah.
not
No,
pretend. Yeah, let's not
we all
pretend
know it's here
it's
in
not this.
certain areas.
It's not a
Absolutely.
narrow definition of CPI. If you're looking there, then I would say that you're allowing someone to distract you to look in the wrong place.
But
This
again,
is
what do you
my
do?
own thinking on this. You try to
What
get
what does the average investor watching this
yeah
show,
my approach
do about that?
You have to have
my
some,
approach is to find stuff
right?
that's already
Because
reacted to it
say,
and
say
get on board. So like I've put out 4 offers on what I would say is desirable property around the New York area.
Wow.
None of them closed. And the what I keep hearing from brokers is, gee, this would have been a good offer 2 months ago. Now, like I'm losing out by like 7 to 8%. So inflation, there's again, that's a
There's
sheer
huge
sign of
housing
inflation.
inflation. Yeah.
Yeah, and luxury stuff. I mean, 3 of the 4 were like, either we're waterfront, either ocean or a river of some kind, right? And and I mean, can you imagine somebody says, yeah, that would have been a good offer 2 months ago?
Right. Well, you know what? Then let me just say, a reaction to that could be to go with REITs, because if you find the right REITs, I'm a big, believer in REITs because you get an interest rate, and certain ones, you have to have the right REITs. But that's real property. Maybe you go with energy. That's real assets. Maybe you do go with gold. Maybe you don't. But these are the things you have to weigh out. What are you
Right.
gonna say?
so that you have to have a reference point somewhere, and the CPI is not the sort of the whole picture. But you can't just talk about New York property and the increase in New York property prices, and then say, well, the CPI headline rates are not an accurate reflection of real inflation. Because if New York property prices have gone up more than, say, prices of real estate in Kentucky, this would be the same as a person in Kentucky saying, well, before it took me 10 houses to buy one apartment in New York City. Now it takes me 12. So therefore I've experienced more inflation than what the CPI indicates. That's not really right. And of course, CPI is a federal rate, divided by the average. Of course, different economies, different states and all that are going to experience different things. That's also the same internationally.
Right.
How many houses
I
in
agree.
Sydney?
I agree. It's great.
But you know what Joe? What Joe is saying is that
Inflation is granular. It's granular. It's what you want to buy. So I don't care if milk goes up 5 cents, for example. That has almost no effect on my own budget and stuff I want to buy. Right.
But it will have an effect on the milk farmer. It will have an effect on the milk farmer. Right?
you know what?
It will. It's a granular thing. Inflation is what matters to you, what you want to buy in the future. I don't think
what Joe is saying, Shaquille.
On an individual basis, inflation matters based on what you're spending and what you're earning. But the CPI is measuring things across a basket, and it's averaged across the whole nation.
You're both absolutely right. Shaquille is right because the CPI doesn't measure all inflation, but Joe is right absolutely about housing prices. You know what? I've recently heard stories about people in far out places like Tennessee and Florida and other places where even locals cannot afford to bid for their houses anymore because people are coming in with cash offers, and people are getting. My brother just did this. He just sold his house and without an inspection and without and he had multiple bidders. It was in Seattle. Multiple bidders, like 8 bidders, sold for more. No inspection, no terms, no, it was a cash deal. And this is happening in Tennessee. It's happening all over the country because basically rates are low. There's a lot of cash out there, and there's huge housing inflation. And then but Shaquille is right too. But Shaquille, you're absolutely right. The CPI.
The point that I'm making is, if you talk about inflation, if you talk about that in that way and say, well, we're experiencing housing inflation, then what happens? Let's just say gold, just for example. What happens if the prices of housing starts to stabilize and the prices of gold goes up? Do you then say, well, we've experienced housing deflation? Because the price of houses may have also continued to increase. So, you've got to look at what you're measuring against what you're measuring.
You're absolutely right, Shaquille. That's why I said you're both right.
You're measuring a commodity or a Bitcoin or this or that. To just say inflation, deflation in those ways, I think detracts away from the macroeconomic theories that we're looking at, which is money supply and the health of the economy. Of course, individual assets or individual asset classes will, of course, deflate and inflate versus another commodity or asset. Roger,
maybe we should get into some specifics because it's 1:51.
Yeah, we are getting close.
I would point out that according to what I heard, I believe Shaquille would probably be optimistic on Australian economy and Canadian economy in the long run, which is interesting. I have a bunch of Canadian stocks, nothing in Australia, and I was looking at the EWZ, but it doesn't have a great yield now. It's really high too. The Australian stock market is too, so it makes it tough. I'm going to throw in a Canadian stock and a U.S. stock that I like. First of all, I've mentioned it before, but I like it more than ever. I've looked at all the telephone companies around the world, and I like TELUS, TU, Canadian company. Yes. It's in Canadian dollars, which I do like that for diversity. Paying almost a 5% dividend rate. It's been increasing its dividend steadily for 10 years, and it's already promised to increase its dividend by 7 to 10% a year for the next several years. And it's easily got the cash flow to do it. It's price over cash flow, which is my favorite measure to look at, is 7.7. So they're really earning 12 or 13% on their money. And they've got a sort of, not a full monopoly, but they've got a big lock on the west coast of Canada. Yeah. So TELUS is one of my really big ones. I'm 3.5% in TELUS, and I'm staying there. I might want to do more down the road, but to get that kind of yield, I keep it in an IRA, which avoids the 15% Canadian withholding tax. Or you can have it outside, but then you have to pay a 15% withholding tax.
Something else, I'd like to emphasize one thing, and I followed for several years all high dividend-paying stocks, which TELUS you can consider one of them. In case of correction, say 10% or so, the high-paying dividend stocks, generally speaking, going much less down than the remaining stocks. Because let's see, if you take stock, my favorite Canadian stock is Enbridge, still is, and it's paying well over 7% dividend. And I can't imagine that it can go down even 10% because then its yield will move up to 8.5%, 9% possibly. So it will become so attractive that people will flock in, and Enbridge will very quickly will retain its value. So I think this is something what to consider. Just if you are at this point with what we discussed about inflation, if we all defensively minded investors, so to say.
I like Enbridge, Sasha, and we had talked about that, and we both bought EPD. We never got. I don't think we'll have time to get into this, but yes. We both bought EPD separately the other day, last week.
That's right.
And you had said you'd bought call and put options, so I don't know if we'll have time to explore that maybe today.
Let me say quickly what you said, Peter, about and what you said before about dividend stocks. I think it's just worth noting, just quickly about Canada. Of course, if you're in the United States, you should look at the tax code and get some advice on that, because you can get, for the audience, you can get imputation credits, obviously, for foreign withholdings. But let me say very quickly, a country like Australia, and Canada is much the same, but a country like Australia, we actually, our companies, our ASX 20, so this, for example, the Dow, the ASX, will actually pay reasonably high dividends. 5, 6, 7% is not unheard of. It's not unreasonable for our companies. Different mentalities in the US. Boards tend to think if we pay a dividend, we're telling our investors that the money's better off in their hands than us investing it. Australia doesn't look at it like that. Most Australian boards are happy to pay a dividend. So it is interesting to see how countries that have generally reasonably high interest rates actually perform, because you'll tend to find that a lot of those countries will have stocks that do pay dividends. Singapore is a very interesting one as well, because a lot of their companies will pay dividends. Just quickly to your point, Sasha, you're right in what you're saying, that high dividend stocks will tend to do reasonably well. But I think part of the reason that you're seeing that is because a lot of them are utility based, which means that their cash flows are not quite as affected by market movements, especially if we're talking about telcos or electricity companies. So just keep an eye on that, because otherwise you will see mining companies, for example, cut their dividends when the market turns down.
Well taken point. I agree with you.
You tend to get a different investor in a lot of these dividend stocks, and a lot of people want to hold on. Look, people are retiring all over the world. They want income. And if rates are going to zero, nobody knows if they are in the next 8 or 10 years everywhere, then it's going to be almost invaluable to have flows of cash, because and you get it especially if you get a dividend stock that's growing its dividend. With Enbridge, I just want to mention, and then I want to mention one other one, just because I like to get these specifics in. It's very important to give specifics. My concerns with Enbridge and why I like EPD better, I put 2/3% in that one, is people will have to research this, or we can discuss it next week, but there's two huge pipeline problems with Pipeline 3 and Pipeline 5. Michigan is trying to close down Pipeline 5, and they need permission to repair Pipeline 3. And the U.S. government right now is Shaquille knows this. Shaquille's always talking about it, and I try to avoid it, but it's so true. It's so inefficient and so kind of a crazy atmosphere right now in terms of, ideas over reality, So, sometimes it makes their ideas aren't bad, but the reality is different. Exactly. So Enbridge, I'm watching that very closely. If they resolve that 3 and 5, I'm watching it weekly. I bought one share and I track it. And if they resolve 3 and 5, I'm like, that's a great company. But right now, EPD, is not my favorite. Because I like MPLX, USAC, but and TRP a lot, which is a Canadian company too, 80% natural gas. But let me throw one other one out there too for people if they're interested.
Quickly say, just be careful, I think, with just looking at yield, because of course oftentimes we see preference shares that are more stable with a yield that don't perform as well as a normal share, and also you'll see that with bonds and that sort of stuff. REITs, like Westfield is a really great example, where the Westfield Trust, although it pays a healthy, stable yield, it doesn't perform as well as the underlying actual Westfield company.
No, believe me, I dig into these companies. I have a kind of, it's not a funny joke, but it's just, my joke is, all I want out of investment is growth, yield, and value. Which is, everybody wants one or the other. I want all three, and it's a lot of work.
It sounds like you're going to vote for the Democrats.
It's a lot of work. But let me throw out IDA. Now, we don't have a full discussion of this one, but IDA is Idaho Power. And why do I like Idaho Power? 3% dividend. It's been growing its dividend at about 7% a year steadily for years. It's highly regulated. Unsurprisingly, guess what the number one state is in the United States for growth, percentage-wise? Idaho. You wouldn't think it, but it's partly the Mormon population. It's a very nice place to live. Utah's up there too. Nevada's up there too in the top 5. But Idaho's a huge growth place. I have 3% in this one. They've been growing like clockwork. Their cash flow easily covers their dividend. It's about 14 cash flow, so it's 5.5%. Covering 3% dividend. But as I said, clockwork. Now, I had a little more, but I read an article. My only concern about them, why I dropped to 3%, is they said you have to be careful about small utilities, because sometimes there's an earthquake or a fire. So I said, okay, 3% is enough in this one. But it's not a fire zone, and it's probably solid growth company. Now, why also Idaho? Because I stay away from all utilities. I would like utilities except for one thing. I've read McKinsey studies that show that solar power is coming on strong, and it can really endanger utilities. And there's going to be a real fight for the utilities to restructure, survive. A lot of it's a battle. Nevada in one day the Nevada utility lost 5% of their power because some of the casinos decided we're going to just put in solar. And it's because solar is getting much more efficient year by year, the battery technology and everything else. So you say, wait a minute, I don't want a utility down south where it's nice and sunny like Arizona. I want something way up north like Idaho, or somewhere up there, because it's going to be harder to put in solar. So that's what I think.
Roderick, what do you think about high-paying dividend stocks? Do you have any favorites?
To me, they're overpriced. They're overpriced. I'm buying tips.
Which one?
I'm expecting inflation, and I'm also expecting shift out of long-term treasuries more and more, out of TLT and these 20-year plus treasuries. I'm expecting that to shift more and more into tips. And I don't really care how much of that or how we measure it. I'm just more inclined to look at the psychology of it. In other words, the more that people come on board thinking that prices are going to go up and rates are going to go up, the bond people are going to move out of funds like TLT and into tips. So I've been buying tips for the last 2 months.
What percentage of your portfolio is in tips?
Matching. Would you consider matching and
my portfolio is about a third gold, silver, and miners, and about a third in tips now.
Wow.
And about a third short. I'm short Tesla. I'm short Carvana. I'm betting against tech. So I've got a kind of riverboat gambler portfolio right now.
You do.
Roger, would you consider, given your views on inflation, would you consider duration matching, short selling treasuries, and then going long the same principle on tips? Would that be something you'd consider doing?
That's
Yeah, very good strategic thinking. Speaking about, we have to finish our show in 1 minute. I'll just tell you that by talking about technology and watching last week's on Sunday, there was the Oscars. And I figure out by watching that maybe to look at the idea of Netflix, because they are being very successful at presenting high quality programs. And it seems to me that others like Disney's and so on, they are adopting Netflix model of producing shows. So Netflix maybe has a way to run, but again, it's not for everybody. It doesn't pay dividends, of course, and there is intrinsic value. I don't think there is much to talk about it. So the only thing is, it has a very good growth potential.
We can short the
This is
Oscars.
not for everybody.
We can short the Oscars, short the Hollywood foreign press, and go long Netflix and Disney. Is that the trade?
That might be it. I've been thinking about that.
My only, if you don't mind, in the last closing seconds, my only guidance
Sure.
is for inflation hedges, I would just look for stuff that's already reacting to it. That's what I would say. If something's not reacting to it yet, then I just don't have faith it will, because how can you not react to, money supply 40% up? So I'm just looking for stuff that has. And what's missing in my portfolio, what I feel I need more of, is more luxury real estate, like I talked about. So that's where I'm at.
Tough year last year, Joe, because things that we ordinarily look at, such as gold, such as bonds, and then the markets that are supposed to be negatively correlated, all moved in unison last year. Now, I had a phenomenal year last year, but the reason it was so phenomenal was because my negative hedges went up at the same time as my other instruments went up. That was one of the primary reasons why. Had I been on the wrong side of all of that, what I would have been hoping would have protected me, everything would have gone down. I know a lot of hedge fund managers and professional money managers struggled last year. Is that going to be something that repeats? Now that it's happened, it's happened. It never had happened before. So it is interesting. I think it's a very, very tough thing to forecast, but let's see what happens.
Yeah.
Well, listen, everybody, I would like to thank you for a very, very interesting, sometimes controversial discussion today. And I'm looking forward to see all of you on next Wednesday for the Modern Investing. Thank you so much. It's IBM TV show, Modern Investing. Thanks a lot, and see you
Thank you for
next
having me.
week.
Thank you to the
Have a
other
good
folks.
luck.
Thanks. Bye bye.
Bye. Have a good day. Bye.
Bye bye.